Peace, power, and prosperity, family. How we doing out there? You already know what time it is. The Bitcoin Block Bully coming to you once again with an early rising crypto update. We are recording live on YouTube as well as New Money Matrix podcast right now, and we're going to be talking about insurance within this cryptocurrency space. And not so much insurance like one would think, in the sense where you have to go to a financial or a centralized institution and sign up, get insurance on the house, the vehicle, life insurance, mobile device insurance. Any type of insurance is put in place for the individual to feel safe about any type of mishaps that may come to the item that is being insured. Um, and how insurance truly works is that individuals pool their funds together for the benefit of the individuals within the pool. In case anyone within the pool has a mishap, the funds are there to take care of that. So it's really a joint effort when we look at how insurance actually works. And within the cryptocurrency space, there are two main, should I say, insurance companies with policies that individuals should be conscious about. And there are another two platforms that I'm going to introduce you to, which act in the capacity of an insurance policy. For anyone that trades options, may know what I'm speaking about, especially within the Bitcoin space, where you may be long on Bitcoin and maybe seeing a downtrend possibly about to come in, and may want to cover that long position with puts, or you may be short on Bitcoin and may want to cover those shorts with calls. And individuals that trade options know what I'm speaking on right now. So we're going to take a look at a couple of platforms also that give the ability for you to put options on your Ethereum. So the first one we're looking at here is called Nexus Mutual. And this is a people-powered alternative to insurance. This is the top insurance company within the DeFi space, or decentralized finance world, where individuals are able to place insurance against any type of smart contract failure. Meaning, if there's a bug that is taken advantage of, which some may call being quote unquote hacked, here you're able to actually place insurance on those different contracts. And when we say contracts, we mean the different decentralized finance applications that individuals use within this space to further their advancement of asset management and interest gains or profit gains. As you can see, it's a shared risk, a blockchain-based solution. Nexus Mutual uses the power of Ethereum so people can share risk together without the need for an insurance company. Secure risk and potential bugs in smart contract code. Be covered for events like the DAO hack, which for the individuals that have been in the space for any time, that was the actually the hack that created what we now know as Ethereum. For those that are familiar with ETC or Ethereum Classic, it's called Ethereum Classic for a reason, as it is the original version of Ethereum, and Ethereum is the, if you want to call it, hard fork of that original version, where there was a quote unquote bug to the original code that the DAO was created on, where a couple $1 million was siphoned out, and individuals had the choice to continue on in the original block or create a new block. And what they did was created a new block. Hence, now you have the Ethereum network as well as the Ethereum Classic network. Let me see. So it says mutuals to replace insurance. We are building an alternative risk sharing platform. In the future, we plan to offer crypto wallet cover, as well as more standard products like earthquake cover. And there's actually some other there's another platform that has testing sites for certain advancements within this crypto space, and they also have a couple of insurance policies. And I actually seen the earthquake one being created there. Let me see. What we're gonna do is we're gonna dive in real quick, and we're gonna go straight, and we're gonna click on get a quote and see what the coverage is like. See if we can get some examples up here. So what you're looking at now could be looked at as the back office, and it says buy smart contract cover. So this is basically the process. You look at the details. Your quote is generated. Now with Nexus Mutual, there is a KYC process where you do have to go through a process where you give up your name and possible personal information, such as identification documents, and then you'll be able to buy the cover. Now we're going to be looking at another one called Open, which is a secure decentralized finance, which allows for you to protect your DeFi deposits and hedge your Ethereum risk. And this one is completely decentralized, whereas all it takes is a wallet connection, and then for you to pay the policy. And we'll take a look at this next. Going back to Nexus Mutual, as you can see, there are a number of different decentralized finance platforms that are able to be covered under this policy. So we have Compound Finance, DDEX, DYDX. You have Uniswap, Nuo Network. You have this is OX, excuse me, the OX protocol. Then you have Instadap. We have the MakerDAO multi-collateral platform, which you're able to create vaults, originally known as CDPs when it was single collateral DAI. You have the Gnosis safe, which is very important for individuals that have any type of businesses running and using the Gnosis safe. You have another one I'm not familiar with here. I'm not familiar with the tag, as a number of these don't have names, but I'm familiar with their logos. You have 1inch, and then you have Idle. Let me see what exactly is. I wonder what. Okay. Oh, that's Aave. Okay, so that's Aave. You can get an Aave Nexus Mutual contract. Let's one individuals may be more familiar with is probably Instadap. So we'll look at Instadap and see what type of coverage we can get. So let's see if we want to cover, let's say 5 Ethereum, right? Or let's say even we want to do 500 DAI. We could do it either or. So what you would do is the cover amount, and this is the amount you will receive in the event of a valid claim as a fixed sum payout. So when is a claim valid? Nexus Mutual smart contract cover is for unintended code usage, where someone, not necessarily the cover purchaser, has suffered a financial loss on the contract. And then we have, how do I make a claim? Claims can be submitted up to 2 times per cover using the make a claim interface. Real simple. Let me see the time. Enter the length of time you want to be covered for. So let's say we want to be covered for 150 days. So let's go ahead and get a quote. And right now what it's doing is calculating the information that we input, and what it's going to do is end up kicking us out a quote. Now I've been here a couple of times actually showing individuals the platform, and it may have taken a while. This time it did not fail us though. It came through pretty fast. Okay, so here we go. So the cost of the cover is $2.70, and that's to get a fixed payout of 500 DAI. The current value is $506.19 US dollars, and the cover period would be 150 days. And this quote is actually valid for 60 minutes. So what you would do is you would continue, and then it would show you the membership and everything you have to go through. In fact, I'm actually gonna cover this with you for individuals that are watching or listening in. To purchase cover, you need to be a member of Nexus Mutual. This gives you legal rights to the assets of the mutual and involves a one-off membership fee of 34 cents, or 0.002 ETH. The process of becoming a member can be completed in parallel with the cover purchase being confirmed on the Ethereum network. To become a member, you need to verify your identity using our Know Your Customer anti-money laundering process. If this fails, your cover contribution and membership fee will be refunded to you. If you prefer, you can complete membership before purchasing cover. You can also trigger a refund anytime during the membership process. Unfortunately, we cannot refund the gas fee at cancellation, and that's the fee that it takes for you to do any transaction on the Ethereum network. Now, due to various laws and regulations, unfortunately, we cannot accept members from the following jurisdictions. And note that they're calling them jurisdictions and not what one would think are called countries or states or cities or anything to that effect. We are working hard to try and reduce this list in our future. So they got a list here. I guess I could run through it. China, Ethiopia, India, Iran, Iraq, Japan, Mexico, North Korea, Russia, Serbia, South Korea, Sri Lanka, Syria, Trinidad and Tobago, Tunisia, Vanuatu, and Yemen. Now, the interesting thing about this platform is the way that it works. They actually have a currency called NXM currency. Let me see if I can find a simple breakdown on here somewhere that takes us through exactly how their currency works. Here we go. So if you wanted to buy, let me see, get a quote there. There's the white paper. Let me see. Okay, here it says that a smart contract is not a contract of insurance. Fellow members will decide on claims. Claims payments are enforced by token-driven economic incentives rather than placing trust in an insurance company. And that may be the link that we're looking for. This is the team, or they may have. Let me see if they got it down here anywhere. And usually I like reading the Medium articles for some of these platforms as they are very, very informative. Let's see what this takes us to. And this is taking us obviously to the white paper. Let me see how long this white paper is. We may find a better article on the Medium page. Let this turn itself out real quick. Okay, so here we go. It's about 16 pages. Let me see. See if we can get to the nitty-gritty of it. Okay, so here he is. Under membership, it says a simple ERC20 compatible token will be created to serve as the key eternal incentive mechanism to bind the mutual together. Now, ERC20 tokens or ERC20, ERC721, these are tokens that have been created on the Ethereum blockchain. A large majority of the cryptocurrency space was actually created on the Ethereum blockchain, which in my opinion makes Ethereum that much more valuable over other tokens because of the use case of it. It goes on to state a continuous token model will be used so that tokens can be purchased at any time, but at a variable price. This contrasts to more common ICO type approaches where there is a fixed purchase period with set price change points, followed by a speculation driven market on exchanges. The token price will vary based on one, funding level of the capital pool, and two, the minimum amount of capital required to support existing covers, which provides a link to business growth. Let me see, we do have some calculations down here, which I'm not, well, for those that, I like a good math problem. So for those that can see, we have TP equals A plus MCR ETH over C times MCR percentage squared. So if I'm reading that correctly, so TP is the token price in Ethereum. MCR ETH is the minimum amount of capital required to support existing covers. The minimum capital requirement in Ether, the MCR is calibrated to a 99.5% solvency level. The MCR percentage is the ratio of capital pool funds to the minimum capital requirement, and the ANC is the fixed constants to be calibrated based on the prevailing ETH price before launch. I know that was a mouthful. I'm gonna let people, go back over that as they they choose and try to figure it out. Tokens can only be created in the following ways. So the initial tokens, some tokens will be set aside for founders and early contributors when the contract is deployed. The second way is purchased via the token price model. Anyone at any point can purchase tokens via the token price model. When funding is required, i.e. low MCR percentage, the price will be lowered to encourage funds to be placed. Conversely, the token price increases when funds are more plentiful. Prices are also increased based on the business growth represented by the growth in the MCR, which places a natural throttle on the token insurance. The token model ensures a balance is reached between the adequate compensation for the risk taken by early participants and allowing future members to join at any time. Third, you have the claim asset assessment rewards. Additional member tokens are allocated as an incentive to perform claims assessments. This will be limited to a fixed percentage of the cost of cover. And you have the fourth, which is the risk assessment rewards. Additional member tokens are allocated as an incentive for participating in risk assessment. And then you have coming in at number 5, you have the governance. Additional member tokens are allocated as an incentive for participating in governance. While the supply of member tokens is not fixed, all methods of generating new member tokens require specific contribution to the mutual. Contributions are made as either funds or services, claim assessment, risk assessment, or voting and governance. Now, membership tokens can be used in the following ways. I want to read all this. Yeah, we'll read through the token usage. Number 1 is purchase and cover. Members' tokens can be used or burned to purchase cover. In this case, the token value was determined by the continuous token model. 90% of the tokens used or burns, with the remaining 10% locked for the cover period plus 35 days, as they are required to submit a claim. Number 2 is the claim assessment stake. To participate in claim assessment and earn the resultant income, members' tokens must be staked. And that's a proof of stake model for those that understand what that is. That's you staking or having stake within a currency or within a company or within a platform or within a blockchain by utilizing the specific currency and lock it into a specific wallet. 3, the risk assessment stake. To participate in assessing risk and earning commissions, a stake is required. And then number 4, we have the redemption. If the capital pool has sufficient funds, redemptions of members' tokens in exchange for Ether is permitted. And I think that we will pretty much, because I think it's getting a little technical, and I want to just give a slight overview of the insurance companies or the insurance platforms that are available within the cryptocurrency space. So if you want to check this out, it's nexusmutual.io, nexusmutual.io. And actually, let me actually go to their Medium page. Let me see if they got a pretty good introduction article that we can run through, maybe 5 minutes. Let's see. Okay, here we go. They got let me see, Understanding Nexus Mutual. And I believe it says about a 4-minute read, right on par with what we were looking for. Yeah. So it goes on to state that Nexus Mutual is a discretionary mutual offering an alternative to insurance for Ethereum users. People who join the mutual become members, and members can buy cover to protect themselves against hacks and smart contract code. It is a mutual, and each member can hold tokens which represent membership rights. It runs on the Ethereum blockchain. Things that our members can do: buy smart contract cover, stake on smart contracts to show they think that contract is secure to earn rewards, stake to assess claims submitted by other members, put forward governance proposals, vote on proposals put forward by the team or other members, contribute funds to the mutual and hold NXM tokens, and all members of the mutual are sharing risk with each other. Things that the Nexus Mutual team has developed and will generally instigate discussion on. Note, all these items are open to any member to develop and champion as they wish. So the base pricing, and this has been calculated by insurance experts, actuaries, and advisories. Investments, this feature will be used to maximize return on the pool of funds in the mutual, that's key, and product development. Based on feedback from the community, progression of the Ethereum and DeFi ecosystem and the capacity and expertise of the team. Things that our members are specifically responsible for. Governance, members are encouraged to vote on proposals or put forward their own proposals. Capital provision, members pay a nominal fee for membership and contribute to the pool by purchasing smart contract cover. Members can also purchase NXM tokens to contribute directly to the pool. Risk assessment, members can stake against the security of a smart contract and get rewarded for their staking. Enough staking needs to happen before anyone can purchase cover on that smart contract. Staking with Nexus Mutual is more knowledge-based than with other DeFi systems, and therefore should be undertaken only by members who are prepared to risk losing their stake if there is a claim on a smart contract. It should be considered as active rather than passive staking. We are also currently working on a new pool staking system, which will change the way staking rewards are distributed. And then you have claim assessment. When the Nexus Mutual is alerted to a claim, members will be asked to vote on whether to pay out on that claim or not. Claims should be resolved within 12 to 48 hours. Next, you have the token. And I'm going through a lot of what we may have already gone through, but repetition is key when you want to understand something. The NXM token represents membership rights in the mutual, with all members owning the mutual together. It runs on a bonding curve, which is a mathematical curve that defines the token price based on specific financial metrics. It can only be bought and sold with the Nexus Mutual application. Only members of Nexus Mutual can hold NXM tokens. The legal framework, Nexus Mutual is a digital cooperative, a DAO, which stands for Decentralized Autonomous Organization, with a legal wrapper around it, and operates as a discretionary mutual in the United Kingdom. Nexus Mutual complies with the relevant laws and regulations in the country from which it accepts members. As I'm going through some of these platforms, as many of you have been listening to me for a while, I hope this is putting ideas in your head of what not only has been created, but what that you yourself and maybe your team can also create. Next, we have the advisory board. There are 5 advisory board members. Their main purpose is to provide qualified technical guidance to the members of the mutual, as well as enact emergency functions should they be required. Advisory board members do have special powers. However, the members can decide to replace them at any time if they see fit. Common misconceptions. Nexus Mutual is not insurance, and it does not offer insurance because it is a discretionary mutual. Smart contract cover is not a contract of insurance. It is a discretionary cover provided by members of the mutual to each other. Members have full discretion on which claims payments are made. Members are putting trust in the economic incentive model rather than the insurance company. That's key when reading that, because you understand how law is precise in the definition and context of how it's being utilized and used, especially with the wordplay. Staking. Using Nexus Mutual to stake on a smart contract system is a way of demonstrating you think a contract is safe. So only stake with the ones you think that aren't going to get hacked. Any member can become a risk assessor by staking their NXM or Nexus native tokens on a contract to earn rewards. If there is an accepted claim on that contract, the risk assessor's stake can be burned. There must be some staking by risk assessors to enable cover purchases on any smart contract, any new smart contract or smart contract system. We are currently working on a new pool system to more evenly redistribute rewards and enable staking across multiple contracts with one deposit. Let me see, demonstrating material loss for a claim. So let's say purchasing smart contract cover process. You become a member, select smart contract to cover, select how long you would like to cover it for, select the amount you cover you would like, and you're covered. In order to make a claim, members do not have to demonstrate that they lost personal funds, only that some funds were lost from the smart contract. 20% of cover amount must be lost in order to make a valid claim. Interesting. Members can stake their NXM on risk assessment, whether they think a contract is secure, and claims assessment, whether they think a claim should be paid. Members can vote in any way they wish when a claim is raised. This involves staking the available information on a claim and using it to decide whether it is in best interest of each party, the claimant themselves, and the mutual as a whole to pay out. If Nexus Mutual begins denying legitimate claims and thus failing in its core purpose, then no new users would come to the platform and make contributions to it. While it's true that claims would lower the value of the pool, and hence the value of NXM tokens that the claims assessors hold in the short term, claims assessors are also financially incentivized to take a long-term view as they are required to lock up their stake. They do have a couple of links down here to their Reddit, Discord, Twitter, and Telegram group. So I hope that introduction to Nexus Mutual was helpful in some way, shape, or form. What we're going to move on to now is called Open, OPYN, for those that want to check it out. And let me see. They have and they do, I believe. Yep, they do have a Medium. So let's see if we got a proper introduction to them through Medium. And Open is the insurance layer for decentralized finance. Protect your DeFi deposits at open.co. So let's see. Providing insurance. Here we go. Protect. Okay. Open launches insurance platform to protect DeFi users. So let's begin with this, and then we'll piggyback over to the actual platform. Protect your DeFi deposits. The article goes on to state DeFi users are facing substantial risk, and Open is here to provide protection. We've seen an incredible community grow around amazing DeFi platforms that form the basis of an emerging financial system. However, these platforms present many risks, both known and unknown to their users. It's only a matter of time before the DAO hack or a 2007 like event occurs in DeFi, and most users are woefully unprepared. Open solves this by being the first platform allowing Ethereum DeFi users to protect themselves against both technical and financial risk, starting with compound deposit insurance. And it's interesting that they would start with compound first, seeing that a lot of institutional money is actually locked in compound through way of Fireblocks, through way of Fidelity, through way of some of their clients. It goes on to state that the insurance layer for decentralized finance at open.co, you can easily insure your compound deposits. The front end connects you to Convexity Protocol, a set of smart contracts we built on Ethereum. Security is our highest priority, and our team has created the protocol to be safe and dependable, and has been audited by Open Zeppelin. And you can find the Open Zeppelin audit if you click the link for those that are able to actually come to the Medium post. And Open Zeppelin has audited a great number of decentralized finance platforms in this space. I actually believe I think I've done a video on audited companies. I'm gonna have to go look and see if I actually published it. This article goes on to state the platform is a two-sided marketplace designed using tokenized ERC20 put options called O tokens, and it will be the first platform that protects decentralized DeFi users against both technical and financial risk, like liquidity crisis, while also being the first place where ETH holders to earn meaningful premiums on their ETH holdings by providing that insurance. By design, Open is completely non-custodial and trustless, requiring no reliance on claim assessors or risk assessors due to its incentive-compatible design. Protection, insurance, and hedging technology is a vital part of any financial system, and DeFi is no different. We're excited to contribute to the continued growth and maturation of decentralized finance. So that was a pretty good introduction of what Open has going on. Let me see how the next article fares. Let me see. Providing insurance on Open. So yeah, we can actually go through this. This will actually explain for those that will be watching this. Let's run over here real quick. So grow your ETH and USDC. Earn meaningful premiums by providing protection. And like I said, this is pretty much you connect your wallet. You come over, either you're going to buy protection or you're going to sell protection. And it's a very, very, very easy interface. Very easy interface here. At the top, you have the insurance compound deposit, so you can insure your USDC or your DAI. Or you can hedge your Ethereum risk, right? And the protection cost over here for $171, for $160 strike price is $7. For $100 strike price, it is 36 cents. And for $150 strike price, it's $2.09. The current price of Ethereum is $171.39. The duration of the insurance policies are 9 months and 23 days. The uninsured yield APR is 0.4% and 0.63%. Right now, I have no insurance, so you're not going to see an insurance amount. Let's actually go and look at the buy option. Or let's run through providing insurance, then we'll come back over here and do a demonstration for those that are able to see. And for those that are listening on the New Money Matrix podcast, if you ever want, you can easily go to Chicago Crypto Hustler on YouTube and actually watch this play out in the physical. So it goes on to state that for the first time in DeFi, you can earn meaningful premiums on your Ethereum by providing insurance to others for the compound USDC and DAI deposits on Open. So it just has a short introduction. What is Open? Open is building the insurance layer for DeFi. This is the first platform to protect users in DeFi against both technical and financial risk. Once again, repetition is key. Starting with compound deposit insurance. The platform is a two-sided marketplace designed using put options or O tokens on the Convexity protocol. On the other side of the marketplace, Open also allows ETH holders to earn meaningful premiums on their Ethereum holdings by providing insurance. So how exactly does earning meaningful premiums on ETH work? Insurance providers lock up ETH collateral in a vault with a collateralization ratio of at least 140%, and they mint O tokens. And I'm going to be doing a podcast, and I may do a live at a later date on the different tokens that are in this space. You got A tokens, I tokens, C tokens, T tokens, O tokens, and I want to break down the different functionalities of them. It goes on to state, note that your collateralization ratio is your total collateral divided by the amount of protection you're offering. Then insurance providers have two possibilities to earn money on their ETH. They can either sell O tokens to insure buyers on Uniswap and earn premiums, or add O tokens to the Uniswap pool and earn transaction fees from other users' trading activity. Here they have a diagram where it goes from you, the insurance provider. You submit ETH to a vault. That ETH turns to O tokens, and then you, the insurance provider, can either sell to buyers on Uniswap or add liquidity to Uniswap pool, to which you'll get the transaction fees back from the added liquidity to the Uniswap pool, and you'll get a premium for adding to the buyers, for selling to buyers on Uniswap. So what does the return profile look like? Well, being a liquidity provider on Uniswap, as a liquidity provider, you earn transaction fees from individuals buying and selling on the open platform through Uniswap, and have the opportunity to make a large but variable return as a result, as long as you remain above 1.4x collateralization. Otherwise, you are at risk of liquidation. Being a Uniswap liquidity provider also allows you to remove the funds at any time. Selling O tokens on Uniswap to insurance buyers on Uniswap allows you to earn premiums on ETH for that far outshine anything you can currently get in DeFi. Currently 0.01% on Compound. Excuse me, family. And it's currently 0.05% on DYDX. And you will get the entirety of it back as long as you remain above that 1.4x collateralization. Otherwise, you are at risk of liquidation, and there isn't some disaster event, like a technical risk, like a hack, financial risk, like DAI breaking its peg, or a run on Compound. Here, you're taking a similar risk to depositing ETH on Compound, where you earn 0.01% and are exposed to the Compound risk. With Open, you are exposed to Compound risk and Open risk, but earn a significantly higher premium on ETH. And you can learn more specific risk you're taking by being an insurance provider on frequently asked questions, and you can click on that. Which, let me see if this is going to flip us right over. Nope, actually, it's going to open up a brand new web page, and let's see if it's quick and short and simple. What are the risks with earning the ETH yield by providing insurance? Let's see. Yeah, I'm gonna come back and do this. Go more in depth. So it goes on to state, to calculate interest for selling O tokens on Uniswap, you can look at the main dashboard, and the difference between the uninsured yield and the insured yield is the premium for selling insurance, since this is what a user would give up to get insured. So right now there is a 1.28% for USDC deposit on Compound, and a 3.79% for DAI deposits on Compound. And you can see that in the diagram here. So what if I want to close my position before the expiry date? You can close your position at any time by buying back the O tokens you had sold on Uniswap and returning them to your vault, which would allow you to redeem your ETH collateral. One note is that the price of O tokens could have increased or decreased in the same time you first purchased them. And they have an example here, a diagram. Insurance provider you, ETH, buy back O tokens from Uniswap. O tokens go back to the vault. Vault gives you back ETH to the insurance provider, who is you. What happens in the case of an adverse event? In the case of an adverse event, insurance buyers can make a claim by sending their O tokens to protect assets to the protocol. Insurance providers can then pay out insurance buyers in ETH and receive these O tokens and protected asset. And I believe that's about it. Yep, to start earning on your ETH now, sell it. You can go to sell.open.co. That's sell.open.co. So let's run over here real quick. Let's take a look. We're looking at right now, we're looking to buy some insurance on Compound, right? So we have a Compound account here that has an uninsured amount of $933.33, which is a total, let's see, $933.33. So yeah, usually the die amount will be couldn't be a little bit different. Let's see if we go to buy insurance. Let's see. So what is it telling us? So protect die deposits on compound. Right now there's $933. If we wanted to protect this, the total cost to us would be $30.40. That's to protect the $900 account. Now, the maximum loss that you would incur if something were to happen to this account would be $83 in die, right? Versus you being liquidated or any any type of massive losses. So you're looking at the 83 die plus the 0.17 ETH, which right now is $30. So about $110, give or take. And the duration would be 9 months and 23 days. Let's confirm that. And as you can see, the gas fee would only be 11 cents. So I'll come back and actually do a full out tutorial on here at a later date. But this is the open platform where you're able to buy insurance on compound and protect your put options, protected put options on ETH. In fact, let's go take a look. Let's see, hedge. Let's see if we wanted to hedge. Let's see, protection cost, $7. Current ETH price, $171, and the strike price would be $160. So if ETH went down to $160, it would knock you out at the $160 mark and it would cost you $7 for that insurance. If ETH is below 160, exercise to receive 160 USDC, per ETH. And these are fairly simple platforms to utilize, family, once you learn your way around the block over here in the cryptocurrency / DeFi / blockchain space. Now, the other two that I'm going to give a quick introduction to are Hedge. That's hedge.co, which uses non-custodial hedge contracts to protect your ETH from losses and drawdowns in any market conditions. Excuse me. And we have Hedge, the Hedge exchange, which allows you to swap debt and collateral on compound. Take advantage of a bear market by having your debt go down with it. In fact, let me see if they got what we got. We're going 37 minutes right now on New Money Matrix. We may be able to get this out in time. Let me see. In fact, yeah, we can get this out in time. So introducing Hedge. Hedge is a new DApp created by the Study DeFi team that allows you to swap both collateral and debt via compound. It does this by leveraging flash loans from Aave, token liquidity from Uniswap, and of course, loan positions from compound. What can Hedge do? Hedge gives you the ability to instantly swap your collateral or debt between different crypto assets. This is a game changer because this means you can not only save your position when the market is crashing, you can also profit from it as well. Let's see, it says read on when times are bad. Suppose the price of ETH is tanking, just like during Black Thursday. For those that are familiar with that, that's what happened about a month ago, maybe 2 months ago. I was actually on vacation when it happened and was affected badly. But a number of MakerDAO vaults, CDPs, and compound positions were liquidated. And there was about a $28 million loss, if I'm not mistaken. I'll cover the story at a later date as well. But anyways, and it says you are worried about being liquidated because the value of your collateral is dropping very fast. No problem. All you need to do is log on to Hedge, convert your collateral from ETH to DAI. You've just converted your rapidly dropping volatile crypto collateral into a stablecoin collateral. Now, by converting your collateral to a stablecoin, you've effectively frozen your position from the risk of liquidation. But here, wait, this is where it gets better. You can also swap debt. If the entire crypto market is crashing, you can actually gain from this by changing your debt from a stable coin to a volatile crypto. This means that the value of what you owe will actually go down with the market. So imagine not only being protected from liquidation, but also getting rid of your debt during a Black Thursday-like event. This gives traders the ability to gain during both good times and the bad times. In summary, during the bear market, you can swap your debt into a volatile token, swap your collateral into a stable coin. And of course, you can do the opposite in a bull market. Let me see. Due to Due to the limitations in the compound protocol, i.e., inability to transfer debt or delegate management for physicians, we cannot migrate existing compound positions. However, we can import and convert a maker vault position into a compound position, and it is our recommended way of getting started with Hedge. So you would create a vault on Oasis with MakerDAO, create a smart wallet on Hedge, and then import the vault into Hedge, and then start swapping your debt for collateral. So I'm gonna do a full out tutorial on this. May do a class on it. In fact, we'll see how it goes. But in my from my experience, it's I guess it may look like a complicated interface, but it looks simple enough to me. Like I said, I'll come through and I'll do a actual tutorial. And last but not least, we have Hedge. It goes on to state that Hedge is a on-chain options trading protocol on Ethereum that works like an insurance for your Ethereum. It protects your assets from drawdowns and helps you to hold with a peace of mind. Hedge is a non-custodial, trustless, censorship-resistant system with on-chain settlement. So activate to protect your value at ETH. Choose a hedge contract period and how many ETH you are holding. So let's see. Let's say we got 5 Ethereum, right? And we want to, let's say we want to choose a hedge contract for about 8 weeks, right? The current price of Ethereum is $170. The value of my ETH will be $851. The hedge contract price, 2% a week, will be $136, and the fixed settlement fee would be 8.51%. So after clicking that pay and active button, you will need to confirm the transaction of 0.85 Ethereum in your wallet. Hedge contract will be activated immediately after the transaction is confirmed by the miners. After that, you will have a right to swap 5 ETH, which is $851, at any given moment before the expiration, which would be on July 12th. No, excuse me, June 12th, 2020 at 8:49 a.m. The total cost of the hedge contract of 5 ETH for 8 weeks, 0.85 Ethereum, so $144. Let's go into the history. Hedge contracts are good for what? ETH holders. You want to buy more ETH for you mid long-term portfolio, but you are unsure if the price of ETH will not drop in the next few weeks or months. For ETH traders, you want to open a long or a leverage long position and buy ETH, and you need to hedge your position or protect it from the potential losses. For ETH miners, you know how much ETH you will mine in the next month, and you need money to cover your mining farm expenses, but you are unsure if you will have profits in the end of the month. And onboarding new ETH holders, let's say you want to buy ETH for your mom, dad, friend, girlfriend, or somebody else, but you do not want them to lose faith in crypto if the prices fall down. You and your loved ones need to have a peace of mind for the first mile of holding. That's interesting how they put that. And they do have a what is this? Basically, frequently asked questions. What is hedge contract? We've read that already. What does hedge contract protect? Liquidity providers. Okay, how does hedge contract protect the value of my ETH? Liquidity providers are allocating DAI stable coins under the liquidity pool contract. After paying for holding the hedge contract, the ETH address that was used to conduct the payment will be able to activate the release function of the hedge contract. To release DAI, the user sends ETH to the contract and automatically receives DAI that was locked for them. How can I start using hedge contracts? You choose the amount of ETH that you want to hold a hedge contract for in a period of holding. Strike, or the execution price of a hedge contract, is always the current price of ETH at the money hedge contract. Premium and settlement fee are calculated for the chosen amount period. After that, you will be asked to pay the amount in ETH, the premium plus fee, using your wallet. After miners confirm the transaction, you will be able to use your ETH address to execute the hedge contract during a certain period. In order to execute it, you should send ETH to the contract and use the release function. You will automatically receive DAI for your ETH for your address to your Ethereum address. What is the price of holding a hedge contract? To hold a hedge contract, the user should make an upfront payment of 2% of the desired amount to hedge premium for each week of the holding, plus 1% of the amount settlement fee. Example: if the user chooses to hold a hedge contract for 10 Ethereum for a period of 2 weeks and the current price of ETH is $220, then they need to pay $88 as a premium plus $22 as a settlement fee. So $2,200 is the value of 10 ETH, 88 is a 4% premium, 2% per week, and $22 is a 1% settlement fee. What amount should I lock as a collateral to hold a hedge contract? Not a single not a single stable cent. The holder only pays a premium plus a settlement fee to have the right for swapping ETH to DAI during a certain period. ETH should not be locked in a smart contract for the period holding a hedge contract. Interesting. How can I execute a hedge contract if your website's front end is offline for some reason? This is key. You can visit etherscan.io/DApp, paste the hedge contract address, and click the search button. Connect your wallet and click the right contract button. Go to the release section, paste number that is equal to the amount of ETH that you have activated a hedge contract for. For example, one, your hedge ID, for example 20, or for example, one, your hedge ID, example 20. Your hedge ID can be found in the event logs of the ETH transaction of the activating hedge contract. Data equals your hedge ID. Click the right button and approve the transaction. ETH will be sent from your Ethereum address, and you will automatically receive DAI from the liquidity pool contract. And I know that this is a earful for individuals that are new to the lingo, but I promise you, the more you learn this, not only are you going to activate certain things within your mind and your brain that is almost like an exercise, you're gonna start to comprehend the certain things that you're seeing in this space. What if you will not agree to swap my ETH for DAI after the price drop? The liquidity you have paid for is locked on the hedge contract for you. Nobody can reject you from releasing it, from swapping from ETH to DAI when the price of ETH drops. That is the purpose of hedge contracts, to protect your assets from the price drawdowns and guarantee you that you will be able to swap your ETH to DAI if the price of ETH drops. So whom do I swap my ETH to DAI with when executing a hedge contract? Liquidity providers are allocating DAI on the liquidity pool contract. You are swapping ETH to DAI with a smart contract, not an individual. When a hedge contract is active, the liquidity in DAI is locked. You have a code-based guarantee to be able to swap your ETH to DAI when the market price of ETH is lower than the amount of DAI on the hedge contract that you are holding. What are the terms and conditions of Hedge? Hedge is an unstoppable software in beta that has been audited, that has not been audited yet, and they have a warning. Use it at your own risk. The terms are: if you want to hold a hedge contract, you can pay for it and use it. If you do not want to use it, you do not have to pay for it. Hope that your life and health conditions will let you use hedge contracts. Code is open source on GitHub, meaning anyone can do it. Do your own research. Thank you for the time spent on reading the terms and conditions. If you do not agree with them, please consider leaving this website immediately. And what is the privacy policy of Hedge? You will need to use a Web3 wallet called MetaMask or Wallet Connect to hold and execute hedge contracts. You are unveiling your public key, and everybody can discover that you have used hedge contracts. Hope that you keep your public keys and your private keys in a safe and private place. You will not be asked to provide any of your personal information or CVV code of your credit card. Thank you for your time spent on reading the privacy policy. If you do not agree with it, please consider leaving the website immediately. And family, where we are right now, 47 minutes and 50 seconds leading on right now, New Money Matrix podcast. I do hope that this was helpful for the viewer and or listener. And I hope that it helps to open your mind to the many possibilities that are available in this space that ones may not have known were available to them in order to help secure their investments, versus them just hodling and thinking that there is no type of protection out there. So once again, just to run back through them, you have Nexus Mutual, you have the Open Platform, which is OPYN, you have Hedge.exchange, and you have Hedge.co. I hope this was helpful. Until the next one, this is the Bitcoin Block Bully. I think I'm gonna go live today for the public. Yeah, that's what I'm gonna do. I want to thank the viewer and thank the listener for lending their eyes and ears, and or just their ears. Until the next video, to the next podcast. Peace, power, and prosperity, family. I am out of here.